China's economy isn't just slowing down, it's collapsing in a way that could make Japan's lost decades look like a minor recession. And the scary part? There's no way out. Here's what nobody's connecting. China's real estate market has been declining for 5 straight years. Not months, not quarters, 5 years. Evergrande just got delisted in August 2025. Its shares are worthless. Vanke, the largest state-backed property developer, just lost $6.8 billion and needs a government rescue. Housing prices are down 20–40% in major cities and still falling, but it gets worse. Youth unemployment hit 18.9% in August 2025. That's nearly 1 in 5 young people who can't find a work. And we're not talking about dropouts. These are college graduates. 12.22 million fresh graduates entered the job market this year with nowhere to go. The odds of getting a state job are now 150-1 compared to 25-1 odds of getting into Harvard. The former deputy governor of China's central bank just said publicly that housing prices will never rise again. Think about that. A top government official admitting defeat. That never happens in China. And here's the kicker. Real estate is 25% of China's entire economy. If that sector never recovers, neither does China. In this video, I'm exposing the 5 reasons why China's economy is in a death spiral with no escape, why this affects your investments even if you don't own Chinese stocks, and what you need to do right now before this contagion spreads globally. Subscribe to my channel and turn on notification bell so that YouTube will recommend this content to others. There's one thing about China's real estate crisis that is by far the most devastating, and yet Western investors are completely underestimating it. It's the scale of the collapse. And when you see the actual numbers, you'll understand why this can't be fixed with stimulus. Let's start with what's already happened. Evergrande, once China's largest property developer with $300 billion in liabilities, got delisted from the Hong Kong Stock Exchange in August 2025. Shareholders lost everything. The stock went to zero. Country Garden, another massive developer, defaulted on its debt. Fantasia Holdings defaulted. Shimao Group defaulted. These aren't small companies. These were the titans of Chinese real estate. And now even state-backed developers are collapsing. Vanke just posted a $6.8 billion loss, the first state-linked developer to require restructuring. That's China's Lehman Brothers moment. When companies with government backing start failing, you know the system is broken, but here's what makes this different from the 2008 U.S. housing crisis. In America, housing was about 5–6% of GDP when the bubble burst. In China, real estate is 25% of GDP. That's 4 times larger. The entire economy is built on property development. And it's not just new construction. It's steel mills that supply builders. It's cement factories. It's furniture, manufacturers. It's appliance makers. It's banks that lend to developers. It's local governments that sell land. Everything connects to real estate. Housing investment in China fell 14.7% year over year. New construction starts are down even more. And prices? They've been declining for 5 consecutive years, with no bottom in sight. Here's the data that should terrify you. In Tier 1 cities like Beijing and Shanghai, prices are down 20%. In Tier 2 and Tier 3 cities, they're down 30–40%. And in some smaller cities, prices have fallen 50% or more. But Chinese families are still stuck with mortgages based on the original purchase price. This creates what's called negative equity. When you owe more on your mortgage than your home is worth. And unlike America, where you can walk away from an underwater mortgage, Chinese law makes homeowners personally liable. You can't just hand the keys to the bank. You still owe the full debt even if the home gets foreclosed. So Chinese families are trapped. They bought apartments for $500,000 that are now worth $300,000. They still owe $450,000 on the mortgage. They're underwater by $150,000 with no escape. And here's the worst part. Many of these apartments were pre-sold, meaning people paid for homes that were never finished. Developers took the money, went bankrupt, and left behind incomplete buildings. Families paid full price for apartments they can't even move into. This has created a mortgage boycott movement where thousands of homeowners simply stopped paying. They figure if they're never getting their apartment, why pay the bank? The Chinese government keeps announcing stimulus measures. They cut interest rates. They lower down payment requirements. They tell banks to lend more. But none of it works because the fundamental problem isn't access to credit. It's that homes are overvalued and nobody wants to catch a falling knife. The former deputy governor said it explicitly: housing will never rise again. That's not a correction. That's a permanent collapse. But the real estate crisis is just exposing an even deeper problem. This next social crisis is perhaps the most explosive, because when young people lose hope, entire societies can unravel. It's youth unemployment. And the numbers are so bad that China stopped publishing them for months to hide the truth. In August 2025, China finally admitted that youth unemployment hit 18.9%. That's the official number for people aged 16-24 who are actively looking for work. But economists believe the real number is much higher, possibly 25-30%, because the official statistics exclude people who have given up looking. And we're not talking about unskilled workers. These are college graduates. China produced 12.22 million university graduates in 2025. That's more graduates than most countries have total population, and there aren't enough jobs for them. The competition is insane. For government jobs, which are stable and prestigious, there are now 150 applicants for every position. To put that in perspective, Harvard University accepts 1 out of every 25 applicants. Getting a state job in China is 6 times harder than getting into Harvard. Private sector jobs aren't much better. Tech companies have been laying off thousands. Real estate companies are bankrupt. Manufacturing is moving to Vietnam and Mexico. Finance jobs are scarce. Even teaching positions are oversaturated. So what are young people doing? They're lying flat. That's the literal translation of a social movement called Tangping in Chinese. It means giving up on the traditional path of working hard, buying property, getting married, and having kids. Instead, young people are doing the bare minimum. They're living with parents. They're taking low-paying gigs. They're opting out of the rat race entirely because they see no point in competing when the odds are impossible. There's another movement called Let It Rot, even more extreme than lying flat. It's a complete rejection of societal expectations. No career, no marriage, no children, no consumption, just existing. This is catastrophic for an economy that needs consumer spending to grow. If an entire generation refuses to participate in the economy, who's going to buy products? Who's going to drive growth? And here's where it connects to real estate. Traditionally, Chinese families saved aggressively to buy apartments for their children. It was seen as essential for marriage, no apartment, no wife. But now young people can't afford apartments even with their parents' help, and many don't see the point anymore. So they're not buying homes, they're not getting married, they're not having children. And this creates a vicious cycle. Fewer home buyers means lower housing prices. Lower prices mean more real estate developer bankruptcies. More bankruptcies mean more job losses. More job losses mean even fewer home buyers. The government tried to solve this with propaganda campaigns encouraging hard work and patriotism. But you can't propaganda your way out of a structural economic collapse. When there genuinely aren't enough jobs, telling people to work harder is insulting. And it's not just unemployment, it's underemployment. Graduates with engineering degrees are delivering food on mopeds. Former tech workers are driving taxis. People with master's degrees are working retail for $3 an hour. The psychological impact is devastating. An entire generation feels betrayed. They were told that education was the path to prosperity. They studied hard, got degrees, and now they're unemployed or working jobs that don't require a degree. This isn't something stimulus can fix. You can't print money to create meaningful careers. China has a generation of educated young people with no future. And historically, that's when societies become unstable. And the unemployment crisis is being driven by an even more fundamental problem. Here's the long-term trend that makes China's collapse permanent, and it's something that no policy can reverse. It's demographics, and the numbers are so bad that China's population is now shrinking for the first time in decades. Let me give you the data. China's population peaked in 2022 at 1.412 billion and has been declining ever since. In 2023, the population fell by 2 million. In 2024, it fell again, and projections show it will keep falling for the rest of the century. By 2035, just 10 years from now, 30% of China's population will be over 60 years old. That's 420 million elderly people who need to be supported by a shrinking workforce. And it's not just aging, it's the complete collapse of the birth rate. China's fertility rate is now around 1.0, meaning each woman has one child on average. You need 2.1 just to maintain population. At 1.0, the population halves every generation. This is the direct result of the one-child policy that lasted from 1980 to 2015. For 35 years, China forced families to have only one child. They used forced abortions, sterilizations, and heavy fines to enforce it, and it worked too well. Now there's a massive gender imbalance because families preferred boys and selectively aborted girls. There are 30 million more men than women in China. That means 30 million men who will never find wives. They call them bare branches, men with no hope of marriage or family. And even though China ended the one-child policy and started encouraging births, it's not working. The fertility rate keeps falling. Why? Because raising children is expensive, especially in cities. Housing costs are high, education is competitive and costly, and young people are already struggling financially, plus there's a cultural shift. Chinese women are increasingly educated and career-focused. They don't want to sacrifice their careers to have multiple children, especially when they see how difficult their mothers' lives were. This creates an impossible economic situation. China's economy was built on having a massive, young workforce manufacturing goods for the world, but that workforce is shrinking, and the elderly population is exploding. Who's going to work in the factories? Who's going to pay into the pension system? Who's going to care for 420 million elderly people? Japan faced a similar demographic crisis and has been stuck in stagnation for 30 years. But Japan was rich when it got old. China is getting old before it got rich. And there's another issue. China's economic growth was powered by urbanization, moving hundreds of millions of rural farmers into cities where they became factory workers and consumers. But urbanization is now at 66%, approaching the natural ceiling. There aren't millions more people waiting to move to cities, so China has lost both of its growth engines, a young workforce and urbanization, and there's no way to replace them. But even if they could solve demographics, there's a financial bomb about to explode. Here's the financial crisis that could trigger China's final collapse. And it's hidden in local government debt that nobody's properly accounting for. It's the debt problem, and the scale is almost incomprehensible. Let's start with the official numbers. China's total debt-to-GDP ratio is over 250%. That includes government debt, corporate debt, and household debt. For context, the U.S. is around 260%. But here's the difference. The US has a reserve currency and mature capital markets. China doesn't. Real estate developer debt is at 90% debt to equity ratios. International norms are 40-50%. That means Chinese developers are twice as leveraged as they should be. And we've already seen what happens when that debt can't be serviced: bankruptcy. But the real monster is local government debt. Chinese provinces and cities have about $13 trillion in official debt, but they also have off-balance sheet debt through local government financing vehicles, shadow borrowing entities that don't show up in official statistics. Estimates for total local government debt range from $7 trillion to $13 trillion in hidden liabilities. Some analysts think it could be as high as $15-20 trillion when you count everything. Why does local government debt matter? Because Chinese provinces relied on selling land to developers to fund their budgets. Land sales were 40-50% of local government revenue in some regions. But with the real estate collapse, developers aren't buying land anymore. So local governments have lost their main revenue source while still carrying massive debt. This is creating a debt spiral. Provinces can't pay their debts. They cut services. They delay payments to contractors. They default on bonds. And this makes it harder to borrow more, which forces more cuts, which weakens the economy further. And here's the kicker. China also has about $375 billion in USD-denominated debt, liabilities that have to be paid in US dollars. If the yuan continues to weaken against the dollar, that debt becomes more expensive to service. And with China's economy struggling, the yuan is under pressure. There's also corporate debt outside the real estate sector. State-owned enterprises have massive debts that are kept alive by government support. If the government stops bailing them out, you get cascading bankruptcies. Economists warn that China is facing a bottomless pit of debt. The government keeps trying to stimulate the economy by telling banks to lend more. But that just creates more debt without creating productive growth. And unlike Western countries, China can't easily print money to inflate away the debt. The yuan isn't a reserve currency. If China prints too much, it causes capital flight, rich Chinese moving money overseas, and currency collapse. So China is trapped. Too much debt to grow. Can't print money to escape. Can't default without crashing the system. And the economy keeps weakening, making the debt burden heavier. So what does this mean for your investments? Here's how China's collapse will affect your portfolio, even if you don't own Chinese stocks. First, avoid Chinese assets entirely. Chinese stocks, bonds, and real estate are all high risk. The government has shown it will let private companies fail. Don't catch that falling knife. Second, watch commodity prices. China is the world's largest buyer of copper, iron ore, oil, and many other commodities. If China's economy keeps contracting, global commodity prices will fall. That hurts Australia, Brazil, Chile, and other commodity exporters. Third, prepare for supply chain shifts. Companies are already moving production from China to Vietnam, Mexico, and India. Invest in those beneficiaries, not in China. Fourth, be cautious on global markets. China is the world's second largest economy. If it truly collapses, that creates deflationary pressure globally. Falling prices sound good but actually hurt corporate profits and can trigger recessions. Fifth, watch your U.S. stock exposure. American companies like Apple, Tesla, Nike, and Starbucks get significant revenue from China. If Chinese consumers stop spending, those companies' earnings will fall. The safe play? Reduce exposure to China and China-dependent companies. Focus on domestic U.S. companies with strong balance sheets that don't rely on Chinese growth. So we've covered the 5 reasons why China's economy is in a permanent collapse. The real estate apocalypse that's destroying 25% of GDP with no recovery. The youth unemployment catastrophe creating a lost generation. The demographics death spiral with a shrinking, aging population. The debt time bomb of $40 trillion in hidden liabilities. And exactly what this means for your investments? These are the warning signs that informed investors are watching, while everyone else assumes China will bounce back. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which global stocks will be crushed by China's collapse and which ones will benefit from the supply chain shift away from China. Without understanding this, you could be holding the wrong stocks as contagion spreads. Click this video over here where I break down which companies to avoid and which ones to buy as China's economy implodes. Link in the description. I'll see you in the next one.